Hello and welcome to Mind Map Programme. Today's topic of discussion is non-banking financial companies. First of all, we will discuss what are NBFCs, types of NBFCs, regulatory framework, difference between banks and NBFCs, role and importance of NBFCs, risk management in NBFCs and way forward. First of all, let's discuss what are NBFCs. A non-banking financial company or NBFC is a company registered under the Companies Act 1956. They are engaged in the business of loans and advances, acquisition of shares, stocks, bonds, debentures, securities issued by government or local authority or other marketable securities. A non-banking institution, which is a company and has principal business of receiving deposits under any scheme or arrangement in one lump sum or in installments by way of contributions or in any other manner, is also a non-banking financial company, residuary non-banking company. Now moving on to types of NBFCs. NBFCs are categorized in terms of the type of liabilities into deposit and non-deposit accepting NBFCs and non-deposit taking NBFCs by their size into systematically important and other non-deposit holding companies and by the kind of activity they conduct. Infrastructure Finance Company, that is IFC. It is a non-banking finance company which deploys at least 75% of its total assets in infrastructure loans, has a minimum net owned funds Rs 300 crore, has a minimum credit rating of A or equivalent D and a CRAR of 15%. Systematically Important Core Investment Company CIC NDSI is an NBFC carrying on the business of acquisition of shares and securities which satisfies the following conditions. It holds not less than 90% of its total assets in the form of investment in equity shares, preference shares, debt or loans in group companies. Its investments in the equity shares in group companies constitutes not less than 60% of its total assets. It does not trade in its investments in shares, debt or loans in group companies except through block sale for the purpose of dilution or disinvestment. Its asset size is Rs 100 crore or above and it accepts public funds. Asset Finance Company or AFC. A financial institution carrying on as its principal business the financing of physical assets supporting productive activities such as automobiles, tractors, etc. Investment Company or IC. It means any company whose principal business is the acquisition of securities. And Loan Company. It is a financial institution carrying on as its principal business the providing of finance whether by making loans or advances or otherwise for any activity other than its own. Now let's discuss about the regulatory framework. In terms of the powers given to bank to obviate dual regulation, certain categories of NBFCs which are regulated by other regulators are exempted from the requirement of registration with RBI. Merchant banker, venture capital fund companies, stock exchanges, stock brokers, sub-brokers are regulated by Securities and Exchange Board of India. Insurance company holding a valid certificate of registration issued by IRDA. Nidhi companies as notified under Section 620A of the Companies Act 1956. Similarly, chit fund companies are regulated by the respective state governments and housing finance companies regulated by National Housing Bank. Now let's have a look at the difference between banks and NBFCs. NBFCs lend and make investments and hence their activities are akin to that of banks. However, there are a few differences as given below. NBFC cannot accept demand deposits. NBFCs do not form part of the payment and settlement system and cannot issue checks drawn on itself. And deposit insurance facility of Deposit Insurance and Credit Guarantee Corporation is not available to depositors of NBFCs unlike in case of banks. Now moving on to role and importance of NBFCs. Here are some key aspects highlighting NBFCs' role and importance in Indian economy. Financial inclusion. NBFCs contribute significantly to financial inclusion in India by extending financial services to undeserved and unbanked segments of the population. Credit access. NBFCs increase credit availability in the economy. They cater to the diverse credit needs of various sectors, including retail, agriculture, SMEs, real estate, and infrastructure. Customized financial products. They develop innovative lending models such as vehicle financing, consumer loans, housing finance, gold loans, etc. SME financing. NBFCs play a critical role in supporting the growth of small and medium enterprises, which are the backbone of India's economy. Housing finance. NBFCs provide mortgage loans and facilitate affordable housing finance options for individuals and families. Infrastructure financing. NBFCs contribute to financing infrastructure projects in India, such as roads, power, ports, and airports. And employment generation. NBFCs contribute to employment generation by providing finance to businesses. Risk management in NBFCs. Risk management in NBFCs involves implementing robust frameworks and practices to identify, assess, mitigate, and monitor various risks. NBFCs need to establish effective credit risk management practices to assess the creditworthiness of borrowers, set appropriate lending limits, and manage loan portfolios. They should identify and manage market risk arising from fluctuations in interest rates, foreign exchange rates, and other market variables. NBFCs must maintain adequate liquidity to meet their funding obligations and manage unexpected liquidity disruptions. Additionally, NBFCs need to comply with the prudential norms set by the RBI regarding liquidity management. NBFCs need to identify and mitigate operational risk associated with their internal processes, systems, human resources, and external events. Now lastly, let's discuss about the way forward. The growing importance of the NBFC sector in the Indian financial system is reflected in the consistent rise of NBFCs as a proportion to GDP. The continuous improvement in asset quality is seen in the declining GNPA ratio of NBFCs from the peak of 7.2% in June 2021 to 5.9% in September 2022. Supported by various policy initiatives, NBFCs could absorb the shocks of the pandemic. These institutions play a vital role in the Indian financial system by catering to the diverse financial needs of individuals, businesses, and the economy as a whole. They bridge the gap between the formal banking sector and unbanked or undeserved sections of the population. Now moving on to practice questions. First of all, prelims question. With reference to the NBFCs in India, consider the following statements. 1. They cannot engage in the acquisition of securities issued by the government. 2. They cannot accept demand deposits like savings account. Which of the statements given above is or are correct? 1 only, 2 only, both 1 and 2, or neither 1 nor 2? And now mains question. What are NBFCs and their types? In the light of recent NBFC crisis, discuss the challenges faced by them and give measures that could be taken. So that's all for today. Stay tuned for the next episode. Thanks for watching.